to ever have our chat room embedded in their platform. So we're pretty proud of that. We were the first ones ever to do that like 13 years ago. Since then, Benzinga and some others have followed on, but we were the first. And we also have, a number of free resources on our site, such as newsletters and whatnot. Today, my presentation is going to be called How I Prepare for the Open. And I've made up a couple of some points here that I want to go over. And basically, this is the crux of what I do every single morning, which is very, very important because I feel like every open is different. And I hope that when you're done hearing this presentation, you will have a better understanding and a new appreciation for the amount of nuances that happen in a in any particular trading day in the morning. There's a lot of things to look at that I think a lot of people just don't get. So I'm going to go over that and kind of run you through the entire preparation of the morning. And today, actually, a lot of this is going to deal obviously with today because the open was relatively recent and I have a lot of fresh information to go on. And today's open is actually a perfect day to talk about this because we opened on a large gap, right? Everybody knows we opened, I don't know how many handles it was lower exactly, but we know that yesterday's close was somewhere around, I think, 29.40. And today we opened at 29.23. So we had a 17 handle gap to the downside. So that makes things very, very interesting and gives us a lot to talk about. So, all right, let's start with the beginning here. Start what I wrote, see what I wrote in the beginning. Start top down. What does it mean to start top down? Top down simply means that you are going to start with a approach that starts with longer term charts. You don't have to, you can go out to weeklies or monthlies if you want, but we'll just, for the sake of argument, start with dailies. And you'll look at the ES and the NQ first, and then you'll take a quick look at the cash indices as well. All right, so we start with, I'm going to start with ES. So I'll just put up this chart right here. This was the first chart basically that I looked at this morning when I came to my desk, because I looked at the ES. And I just started looking at different levels on this chart. And I realized that because this chart is a 24-hour chart, this red candle here that you see is actually the candle of today. And in the morning, it had already printed down here. And you can see this big square area to the left here. It had already broken down into it. So I know coming into the open, first thing I'm thinking to myself is, if we're breaking into this balance area, there is potential that we could go lower. I also know that we do have rounded top here. And, you know, basically this balance, this support level here hasn't held. And we could possibly think of the entire move upward here as a look above and fail, meaning that we broke out of balance to the upside. We looked above, we didn't make a new high, and we failed. The fact that we didn't make a new high is important because it puts a lot of overhead supply in the market above us, right? Had the market made new highs, then a lot of longs would have sort of gotten off their longs on the new high, made some profits, and people would be stuck so long. But I kind of know going into it that there's probably a lot of people stuck long. So that kind of gives me an idea that this could be a short day. All right. So now I've looked at the ES. That's fine. Quickly, I will take a quick look at the majors just real quick. Now, obviously, we've already traded all day today, so this chart looks different. And here, obviously, this red bar wasn't here then, but I can see, okay, we're breaking down below this support on yesterday. We probably are going to fill up this area to the downside to the trend line, right? Look at the same thing in NDX. Same thing. NDX is actually more bearish because it broke the trend line, so there's possibility for lower. It wants to now focus on the 73.62 area. And last but not least, I take a quick look at the RUT. Same thing. RUT already actually broke trend a while ago. So the bias has been down, and it makes sense that the RUT is going to probably fill in this area down to 1450. Okay, so now we've done that first part of the analysis where we've just kind of looked at what's going on in the broad market, and it just gives us kind of an idea of what should we expect for this day, like where could we possibly go, right? This is just the very broad overview. And here's where things get really interesting, I hope, because this is where they get interesting to me. Do you understand that what I just talked about, what I just finished, this is where I believe 95% of traders stop their pre-market analysis. That's it, like everything I just did. Just look at the majors. Where are we in terms of levels? Okay, that's it. I'm good to go. All right. this is, in my opinion, not enough. You have to go deeper. So let's start with what I call the 3 questions. You can see that here in the paper, and I will, can I make this bigger? Yes. All right. 3 questions. 1, are we opening within balance or out of balance? Balance is a term that can be defined in a couple different ways. There are balance areas where the market is chopping, let's say for 3 days straight, going sideways. We consider that a balance area. And then you can also consider balance just as the prior day's range. For the intent of this pre-market analysis, I lean more on whether or not we are opening in or out of the prior day's range. I consider that balance, but I also take into effect if there's a larger balance area to the left of the chart. So perhaps we could be opening on a gap, for instance, but we might be opening inside of a bigger balance area. So that kind of tells me, okay, even though there's a gap, the gap may have less import because there's a larger balance area there, okay? So today, to answer that question, are we opening within balance or out of balance? We were definitely opening out of balance, correct? You guys know that we opened on a big gap. We were definitely out of balance. Question number 2 I asked myself is overnight inventory net long, net short, or balanced? Okay, and for that, you need market profile. I'm a huge believer in market profile, and I believe that it is really one of the holy grails and keys to understanding exactly what the market is doing. It leaves a type of footprint on the chart that we don't see with other charts, and I think it's of extreme value. So is overnight inventory net long or net short? How do we determine that? Okay, so today was actually very interesting because these yellow areas are the value areas where 2/3, roughly 70% of the day's volume traded. And those value areas are just part of the entire day's distribution, which would be this column here. That's yesterday's distribution. And notice that that is in capital letters. And these lowercase letters here are all of the Globex activity. So this is all of the overnight activity here. And in the questions that we were just talking about, is overnight inventory net long, net short, or balanced? We figure that out by simply looking at the chart and saying how much of this overnight activity is either above the settlement or below the settlement. Now, 9 times out of 10, when you gap down big, like we are this morning, that overnight inventory is going to be 100% net short. That means that almost all of the activity would be down here under Friday's open, or Friday's low rather, it would be here. Today was actually a very interesting day that I thought was somewhat anomalous, that I haven't seen in a while, in that the overnight inventory is actually balanced, believe it or not, right? Look at how much activity there actually was above yesterday's settlement. And then you have probably some news overnight, and it takes it down here. And these 2 areas, in terms of distribution, how much time was spent, if you added up all these letters, they're kind of even. So this is kind of a day that's slightly tricky because the overnight inventory is not 100% net long or net short. And as I go into my presentation, you'll understand there's a lot of different things you can do with that, with the net long or net short, right? Generally speaking, you want to be looking at inventory skews that are 100% net long or 100% net short. You want to look at those as very special. Those are the ones that you really, really want to pay attention to, because it is those inventory positions that lead to gap fills, basically, where everybody overnight is basically all long or they're all short. And what happens at the open if they're all short? If that market doesn't start going down right away, or if it goes down a little and then it comes back through the open, people are going to be covering like mad. Reverse that in the other direction, obviously, on a gap up. Okay, so to answer the question for today, I would say the overnight inventory is balanced, or it was balanced coming into this morning. Third question, where will the overnight range, and this is a typo, it should say within the, where within the overnight range will the open be? So it's not a typo, I was reading that wrong. Where within the overnight range will the open be? And again, we were here at the green dot. See the green dot? The green dot is today's open. This part on the left is the overnight range. So where will the open be in relation to the overnight range? Is it near the top of the overnight range, or is it near the low end of the overnight range? If you have inventory that is net short and the market is opening near the top of the range, then think about it. Why would you fade that market? It's probably already corrected the overnight inventory in like, the last few hours or so, or, just recently before the open. And there's no reason to be looking for a fade because it's already gone up, right? So, and again, reverse that for a gap up. If you gap up, big overnight inventory all the way to the upside, and yet you open near the bottom of the overnight range, and it's a relatively big overnight range, again, why would you fade it? It's already down, unless there's still a big gap to fill or whatever the case. So now, do you understand that if you've answered these three questions, you now have a huge advantage, I would say, on the rest of the competition. You literally already know tons of information that the average person does not care about, does not look at, and just kind of looks at the gap and says, oh, it's down, I'm going to fade the gap no matter what. I fade gaps, that's what I do. Or they think that news that happened overnight was so bearish, it's got to be short. Even though it's already gapping down 20, it'll continue lower, I'm just shorting. Whatever the case. Do you know what I'm saying? There's a huge amount of information that you've just gleaned from just asking these questions. So I implore you, if you can, ask yourself these three questions every single day before you trade. And mostly, a lot of this stuff I understand is very granular, and it applies to intraday futures trading and intraday stock trading. I understand that. But remember that on the day of entry, even if you're longer term, everybody is a day trader on the day of entry. And also, I understand that Danny is a futures trader. This is a futures type room. So I figured I was hoping that this is very applicable to the people listening in this room. All right. So ask yourself the three questions. All right. Next. Is there a gap? And if so, is it a true gap or not? If it's a true gap, then gap rules are in play. What is a true gap? Okay, the way I define it, a true gap is like this: when you have actual space in between the two trading days. I do not consider a gap to be anything else than that. If a market opens inside of the prior day's range, even if it's far away from the settlement, I don't consider that a gap, and I don't consider filling the gap back to the settlement or close. To me, a gap is only a true gap. I believe there are gaps and there are true gaps. This morning was a true gap because, as you can see, my market profile software puts a big arrow here. If there's a true gap and there's a big separation, it opened far away from yesterday's low. Remember, I don't care about yesterday's settlement. I care about yesterday's low. That's what I care about. So if we open outside of yesterday's low to the downside, that is a true gap. Okay, so continuing on, knowing that we have a true gap, okay, that means that gap rules are in play. What are gap rules? I'll go over that right now as well. Gap rules are another fantastic way, in addition to asking yourself those questions every morning, et cetera, that you can stay out of trouble on these large gaps. They are basically a framework for how to trade gap days, especially gap days where the ES opens more than 10 handles to the upside or downside, okay? Remember that. The gap rules work all the time, but they're most applicable on this type of day when you have a big gap, because oftentimes these big gaps confuse traders. I think people fade when they shouldn't, they buy when they shouldn't, and they don't really have a framework or a scenario in place on how to trade that type of day, so they rack up some losses early. But it would be better if they had a framework. All right, so let's talk about that. Okay, so the framework here is to use these rules. All right, so let's start with number one. Go with all gaps that don't fill right away. What does that mean? That generally means that if the gap is going to fill, it should happen relatively early. If it's not happening relatively early, then it's a go with, meaning you're going to go in the direction of the gap. It's that simple. The larger the gap is, the more difficult it is to pull off number one without some chop. Today is an anomaly in my book. I believe today is an anomaly where it dropped right from the open like a stone. Okay, that is not usually how things happen, especially with these big gaps. And as I go through the rules, you'll see that we have a framework to deal with that using the gap rules. All right, gap rule number two: larger gaps may not fill, or may fill only partially on the first day, and this is important. I put 2 stars here because this one, number 2, and number 4 are, to me, the most important ones. But let's deal with number 2 first. It is very typical that large gaps greater than $10 in the ES do not fill all the way or fill partially. It just is that way. Just statistically, they just don't. They tend to fill later. They'll leave the gap on the chart. I mentioned specifically in the gap rules that they will fill only partially because it is very important if you're fading the gap to use those partial areas of, say, 25%, 50%, 75% as targets and not be greedy and assume that the whole gap will fill. It is very common for a large gap to only fill partially, and maybe you make a little money, few handles, and then you reverse yourself or you get out or whatever. So that's important, all right? Number 3, let's say that the gap fills. Here's where things get interesting. If the gap fills and value cannot get to at least overlapping, then expect a late day sell-off or a late on a gap down or a late day rally on a gap up. What does that mean? Okay, if the gap fills, meaning that we travel all the way to the prior day's close, and value cannot get to at least overlapping, that means that the value area has to overlap with the prior day's value area. For instance, if you look at these 2 days, which are the prior 2 sessions, like this is Tuesday, this is Monday, these values are overlapping. So what happens, let's just say that the gap did fill today. Let's say the gap filled and we breached yesterday's low and we came up in here, but the yellow portion of the profile remained, say, down here. Let's say the value area high was 29.34 down into here, and it never got overlapping. That increases the odds that the market will sell off again late day. And again, you can flip that on the long side if it was a gap up, basically. So if the gap fills and value cannot come down to at least overlapping, it increases the odds of a late day rally, basically, if it was a gap up. All right, same exact thing. All right. Number 4. This one I call the shadow trader caveat because I actually added this one after the first 3. And it says gaps larger than $10 are difficult to trade as the market often spends the morning digesting the gap without actually going anywhere, which results in a lot of choppy action. And again, today is an anomaly. This is not how it usually happens. Usually on a large gap, you'll get the first 45 minutes sideways. There'll be a lot of grind. And sometimes if the gap is large enough, you will get nothing all day where the market will just go sideways. And then the move in the market really all has to be attributed to the overnight activity. And during the day, as far as I'm concerned, there really isn't any tradable activity. And this is where I get really pissed when I see the TV saying, the Dow is down 500 or whatever, but the range from the open is so tiny that who cares? If you weren't short the night before, it's meaningless to you because there's nothing you can do with it. Again, today is kind of an anomaly where we gapped down and started trending from the open, and we remained in a trending environment all day. Okay, so be careful on large gaps. I usually tell newer traders that their best bet is to not trade ES on large gap days. If the gap is larger than $10, sit on your hands and consider that a non-trading day. At the very least, cut your size down in half. These larger gap days are difficult to trade. Okay, so now we've established all of that. Let's just, for a second, recap what we've established. We started top down, we looked at the futures daily charts, and we looked at the indices, and we figured out, okay, what is probably going to happen, or I should say, what is the path of least resistance, basically, correct? That's what we try to figure out. What is our path of least resistance? Next, we ask ourselves the 3 questions. We say, are we opening within balance or out of balance? We look at overnight inventory, and we see where we're going to open in relation to that range to also give us a better idea of what the market might do once that bell rings, okay? Then we check if we have a gap, if we have a true gap. If we don't have a true gap and we just have a gap, then the gap rules are not in play. If the market is opening outside of the prior day's range, then the gap rules are in play, and we use the gap rules to start our scenarios, okay? Once the above has been established, start with our scenarios, okay? What scenarios do you envision happening if the market is opening in balance? All right, let's say we're opening in balance. That's the first question I ask myself, all right? What scenarios would you envision happening if the market opens out of balance? Okay, these again, this is the question you ask yourself. What are the various signposts you would use as targets or action areas? Okay, so let's just say that the market is opening in balance. Okay, so fine, I go into my chart and I basically just start marking off all the nuances. And this what I'm about to talk about goes a little bit further than, it's a little bit beyond the scope of this, relatively short presentation, because there are some market profile nuances here, but you can mark off some of these nuances on a regular candlestick chart, but a number of them will not exist on the candlestick chart, and you would have to have a market profile chart. Okay, so I would look at things like, okay, settlement, that's something. Where is there a very wide part of the profile, high volume node, that's something. Okay, in here I have some single prints. Those are that little single print area is possibly going to act as some resistance. I have value area high, etc. Things like this. I would start looking at these areas. If I was thinking that the day would probably be choppy and we were opening in balance, I would be looking at these areas as, basically either targets or areas that I would be trading against for responsive trade, correct? And as you know, there are two types of trade. There's responsive trade in the futures where you ping pong back and forth off of levels. This is the trade that the floor traders and the shorter term players are good at, right? They tend to look at things in brackets, and if we go up to the top of a bracket, they're selling it, they're buying it at the bottom. That is responsive trade because the market is responding to areas of support or resistance. And then there's also initiative trade. Initiative trade is when new money is coming into the market to initiate new positions, and there's new money buyers or new money sellers. And as we know, initiative trade tends to run further than responsive trade and can kind of make it all the way to the next signpost, sometimes out of the prior day's range, sometimes not. So, there's obviously different ways you want to look at the market if it's opening in balance, right? What scenarios do you envision happening if the market is opening out of balance? And for that, we're going to use today I'll use today's scenarios for that, because that's the type of open that we had. Okay, I will go back to the site now, and I'm going to show you my pre-market report from this morning, which I write every day. And when this is done, if this type of market profile analysis is of interest to you, I highly recommend that you take a free trial. I have this on our site, and you can get the first 5 days free. Go to the members area. I apologize. Okay, and we'll look at exactly what I was thinking this morning on the outside gap. So again, this is my pre-market perspective that I write every morning. And basically, I ask myself all those questions, and everything I just talked about, I do in this report, and I write about it every single morning, and it comes out at 9 a.m. I choose which are the key levels for the day, and I put those up. And I don't just put every key level. I put only the ones that I feel are going to be in play. And if there's anything you don't understand, you can just kind of mouse over. So for instance, you don't know what a VPOC is. That's a virgin point of control. I have tooltips on all the market profile terminology. You can also expand and contract the profile chart. All right. And then I do a little write-up on what I'm seeing. And then I do my scenarios. Okay. And I'm using this here to focus on these scenarios because it is today, and that's where we are. Obviously, in the presentation, we're talking about what would the scenarios be on a day where we open out of balance. Okay, so what did I write this morning? As with any true gap, my first focus is on a possible fill. This will happen in one of two ways. Either there will be an early opening drive, or there will be an early movement lower, which will either fail to take out the overnight low or take it out and get rejected and move back towards the open. In either of the latter two scenarios, your buy point would be when futures cross back through the open with a stop under the low of the day. Monitor for continuation and target the RTH low, regular trading hours low, which would be yesterday's low. Note that if the gap fills fully to the RTH low, that RTH low is often an excellent low risk short point. So do you see how just in the first scenario, I've already given you multiple basically trade ideas, basically how am I going to attack this thing? And this first scenario is only talking about what happens if the gap is going to fill. Now, obviously, this scenario didn't come into play today because we didn't fill at all. But had this scenario come into play, these would have been the things that I would have been looking for. If you just keep some of these nuances in mind of everything that I just said, right? What would I have been looking for? Okay, well, here's the open. So I said the first choice is you either have an opening drive to the upside right away. That means that right from the open, the market would have gone up quickly and started filling the gap. That's kind of difficult to trade because it's kind of a scenario of like, what do I do with that? If I don't buy that right on the open, there's really nothing I can do with it. You're either gonna have the balls to do that or not. And the problem with that trade is that you don't have reference for a stop. Do you understand what I'm saying? You literally like do not have a reference point for a stop. You guys good? Okay. Marlon, just tell me if you hear me and see my charts. Okay, thank you. So as I was saying, that if you go prior day's range, then use the usual signposts as targets, etc. What does that mean? That means that if you go up in here and you start accepting, what you want to do is you want to break up this prior day's range into specific little chunks. Meaning, okay, we've gone into the prior day's range. First target is the settlement. Boom. Second target, value area low. And again, this is reversed, obviously, because it's whatever. I apologize. You'd go value area low first, depending on where the settlement is, right? Possibly to the value area low. Oh, here's the POC. There's another target, right? Keep on going and basically just see how far you can go. You just want to, I call those signposts. You want to break the prior day up into all the different possible areas where the market, quote unquote, could go, and you just start targeting those areas. You don't look at this like willy-nilly and just guess and say, oh, well, I made 3 handles, I'm happy. The market is going to move from starting point to end point, basically. And if you have a gap down and you've moved into the prior day's range, right, then generally you have an immense amount of short covering starting up as soon as you get into that overnight range, right? Think about it. People, especially if that prior day was a bearish day. You have a bearish day, you have a gap down continuation on it, you fill the gap, now you start going into the prior day's range. Well, where do you think people's stops are? Those stops are starting from the low of the day and moving up, and they're just going to get hit subsequently as the market moves up. So you want to be looking for continuation. If you get into the range, say, okay, can I make it to value area low? Could I make it to the settlement? Could I make it to the POC, et cetera, et cetera? Okay, so those are your signposts for continuation that you would look at. In such a scenario, you should see internals strengthen considerably from the gap lows and show positive signs of recovery. What exactly does that mean? Very simply, you're going to be watching your market internals here. This is something that I teach in Shadow Trader every day. We talk about this in our Squawk Box. We've been teaching this literally for 12, 13 years straight. We look at the breadth, we look at the advanced decline line, and we look at the ticks, and we look at the cumulative tick. These are our 4 market internals. And again, it's a little bit beyond the scope of this presentation to go deeper in it, but there's tons of information on our website all about this that you can check out. And I talk about it in my pre-market writings all the time. This is how you monitor for continuation. So on a day, for instance, when you have a gap fill and the gap fill is working and you're thinking that that gap fill might actually go deep into the prior day's range, well, guess what? You will not have negative ticks like this for the first half hour. Your tick will get positive very quickly. In today's case, because we had a gap and go where we followed on, the tick remained negative for the first 30 minutes of the day. That is huge. Think about it. 30 minutes have passed and the NYSE tick did not register a single negative tick, or a single positive tick, excuse me. That is confirming the negative action. All right. And as you can see, I write about that again in the 3rd scenario. If the move is of the gap and go variety, that's what we got today, then the main focus should be on market internals, right? Very often, if there is little to no gap fill, you will not get any positive reads on the NYSE tick. Remember, I wrote this at 9 a.m. this morning, 30 minutes before the market opened. That's exactly what happened. Within the first 30 to 45 minutes, exactly as it happened, or sometimes longer. Target the overnight low first, and then the bottom of the gap. And now in this case, by the way, in the bottom of the gap, that is referencing something below us, just so you know. That bottom of the gap is something down here where we had a gap in here from 29.2150 down to 29.1475. So that first target for a short early would be 29.15 basically. All right, so that's that. And that basically is how I go about my morning, and I start from the top and set up my scenarios, et cetera, okay? That's pretty much it. Again, if you are interested in this type of analysis, this is a report that I write every single morning. It is also very reasonable. I put this out for 20 bucks a month, and you can get the first week free if you're interested. So you can go to shadowtrader.net and you mouse over the futures market profile tab and choose Peter's pre-market perspective right here, and you can take a free trial. Like I said, the first week is on me. read it every day. Give it some time. Give some time with it. It is very nuanced. There is a lot of vocabulary that you might not know, so you might have to mouse over things. It is very market profile based, which like I said, that's probably something for a whole other time. But I firmly believe that if you just use this every day and you have at least the picture of the profile that I provide to you for free, even if you don't have the software, you can mark off these profile nuances on your candlestick chart, and you'll have a much better idea of where the market could go, what the market could do, etc. And if you really ask yourself the questions every morning and you spend like that first free trial week reading everything that I wrote, and again, take it slow, try and digest it, I firmly believe that at the end of just that first week, and I hope you stay on for longer, whatever, but you will have so much of a better understanding of how things work. You know, the number one problem I think with most newer traders is they really do not understand how the market works or what drives price action, and they focus on the wrong thing. The market is driven only by two things, and that is inventory position of the players that have already transacted before you, and supply and demand on that particular day. That is it. And this analysis takes you there, where you already know the inventory position of the prior day's players, not just from the gap and from the open and from the overnight inventory, but you know from looking deeper at the market profile chart where that inventory lies, because you know, for instance, because of that extra dimension of time, and you know, for instance, in the fat part, where did everybody trade the prior day? Where did they not trade? Ooh, look at this thin area. Nobody traded there. Okay, that's important. If I get there, the market probably runs through that quickly. You have so much more depth when looking at a three-dimensional chart that adds the element of time than you would from a chart that is a candlestick chart that only is two-dimensional, which is really just price and volume and does not include the element of time. Okay, so again, check me out at shadowtrader.net. This is where we are at. And again, free trial to the pre-market perspective. If any of this has been interesting to you or you find it useful, again, at the very least, take a free trial and read my report for a week. You can also email me all the time if you want at any time at asktheshadow@shadowtrader.net. All right? Take care, guys, and thank you very much.
Thank God for Mark. But anyways, listen, you guys, Bill Olson coming up in a couple minutes, and let's see what he's got to say.